warm welcome to this special edition of The Global View with me, Tanvir, Gill and Nikunj, Dalmia. Our guest today on the show is a legendary investor whose most recent memo, There They Go Again, has issued a warning to investors world over and has sparked off a debate in world financial markets. None other than Howard Marks joins us all the way from New York to discuss his market outlook.
Good morning, Tanvir.
Mr. Marks, a pleasure and a delight to have you back on ET Now. Thank you for joining us. Mr. Marks, the moment your memo was released, it went viral. And everyone is wondering that what really prompted Howard Marks to come out with a super bearish memo?
Well, first of all, I'd like to not say I don't think it's super bearish. I mean, I think I say in there that I don't think we're in a bubble. I think asset prices are on the high side. Some commentators have said, Howard Marks says it's time to get out. I don't say get out. I don't say it's time. I merely call attention to the accumulation of a number of indicators of a bullish climate. That's all, or at least that's all I meant to do. If I was inaccurate in my writing, I apologize. But I want people to understand that the market has more risk than in the recent past. That asset prices are high, and that people are behaving in a pro-risk fashion. But I don't say get out. I don't say, panic. At Oaktree, for the last 5 years, our motto has been move forward but with caution, and we're still doing that. We are investing. We're not afraid to invest. We're not divesting. We are not preferring to hold cash rather than invest other than in funds which were specifically formed for delayed investment. So my point is, number one, the easy money's been made. Number two, in view of that fact and in view of the high prices and the risk which is present, you should not be as aggressive in your portfolio as you were 3, 5, 7 years ago, and that everything you want to do in the investment business, whether it's owning stocks, owning bonds, owning real estate, everything you want to do can be done in an aggressive fashion or a conservative fashion. And I think that this is more a time for conservatism than aggressiveness. But I hope I did not come across as super bearish.
No, like I said, Mr. Marks, it sparked off a debate. So I think it's really a divide between the super bulls and super bears, and I think that debate continues. The one thing that struck me, sir, when I read the memo was the timing of it all. I know towards the end you've mentioned that it appears to you that we are in the 8th inning, but the game can go on, as in baseball. But somewhere it reflected your own inclination to believe that we are closer towards the end of this bull run. So 2018, 2019, you think could be more challenging years than what we've seen in 2017?
Well, first of all, it's very important to me to reiterate, when you say it's a debate between the super bears and the super bulls, I disagree. I am neither. I am somewhere in between, but closer to conservative. But I'm certainly not a super bear, and I'm certainly not suggesting that we're in a climate like 2007. Now, I wrote in a recent memo that ever since the crisis started back in 2007, 10 years ago, people would always say to me, what inning are we in? And we're still saying, they're still saying, what inning are we in? And I believe we are in the 8th inning, in the sense that the easy money's been made, there's risky behavior, asset prices are high, prospective returns are low, etc. But I also said in that memo that we don't know how long the game will go. When you say inning, you're referring to baseball. Baseball is basically a 9-inning game, and I say we're in the 8th. But investing does not have a fixed number of innings. And so in everything I see advises caution. And yet, we could go another year, another 2 years, maybe even another 3 years without there being any kind of major correction. Anybody who thinks he knows what's going to happen in the investment world is deceiving himself. But anybody who thinks he knows when it's going to happen is really off base, in my opinion. And I sometimes talk about what should happen, but I never talk about when it will happen.
Right. You have already stated that move forward with caution has been your mantra for some months and years now. We spoke the last time you were here in India in March about the global market environment. Over the last 6 months, how has your own evaluation of your stance on caution changed? What has really moved around for you to have penned this memo right now?
Well, there's nothing magical about the time right now. What I do is I gather evidence, I gather anecdotes. A journalist once said, I gather string. And when I have enough things that come together to form a narrative and to make sense, then I write a memo. There is no one thing that happened in the last 6 months or in the last month to cause me to write this now. All I would say is that everything that I say in the memo is more true now than it was 6 months ago. You may say, well, why now, not 6 months ago? This is not a magic time, but, markets have gone higher. And that means that prospective returns have moved lower at a time, in my opinion, when the risks have increased. I think that clearly the geopolitical risks are greater today than they were 6, 12, 24 months ago. When you compare greater risks with higher prices and lower prospective returns and shall we say, accommodative behavior in the capital markets and the ease of doing risky things in the capital markets, all of these things tell me that it's time for caution. There is no magic threshold. There was no day in the last month when I said, aha, now we've passed the threshold. Now I have to put out the memo. It's just a gradual accumulation. And my belief now that we're at the point where I had to speak.
Mr. Marks, you've historically looked at valuations in 3 brackets: cheap, fair, and expensive. So to your mind, which asset class is expensive and which asset class is fairly priced?
The phenomenon I've been discussing so far is a global phenomenon. It's not local to one market or one nation or one region. And the logical condition is that all assets be priced similarly, because if stocks become more expensive and bonds become more expensive, it's unlikely that real estate will be really cheap, because if it is, people will take money out of stocks and bonds, pushing down the prices, and they'll run and they'll buy real estate, pushing up the prices until everything is at what the economist calls equilibrium. So especially today, given the fact that the phenomena that I'm interested in are global, meaning affecting all markets, I can't identify one thing which is markedly cheaper or markedly expensive, more expensive than another. Everything everything is on the expensive side. not terribly, not bubble territory, not panic territory, but expensive. There are no bargains. There is nothing, in my opinion, that can be bought below its intrinsic value. That is the reason for my generalized caution.
So in lieu of that, Mr. Marks, if I were to ask you, as an asset manager, as a fund manager, how would you construct a balanced portfolio in this sort of a market environment where you strike a balance between risk and reward? Where would you scale up, scale down, and how much cash would you keep if there is some sort of benchmark that you're working with in your head?
Well, first of all, a given portfolio isn't right for everybody. Everybody has the portfolio that's right for them, and it's different. The other thing is Oaktree is not a balanced portfolio manager. We don't traffic in the mainstream asset classes of mainstream stocks and high-grade bonds. And our clients give us money and they say, here's X dollars, invest in high-yield bonds or distressed debt or real estate or private lending, whatever it might be. So this is not a question that I answer for a living. Having said that, the universal answer for me is that whatever your normal posture, however you normally balance aggressiveness and defensiveness, I would have considerably more defensiveness today. First of all, I think that in the world I describe, which is great uncertainty, low prospective returns, high prices, pro-risk behavior, I think you have to worry about losing money. And I don't think you have to worry too much about missing opportunity, because I don't see a lot of opportunities that I would worry about missing. So I can't give you a magic number. I can't give you a percentage for cash. I can't give you a balance between stocks and bonds. All I would say is every investor should have in mind his or her normal risk posture, his or her normal balance between offense and defense. And whatever the normal is, I would be considerably more cautious today. That's the only answer that I can give you.
Right. So I'll take a leaf from your answer, Mr. Marks. And you said that we are not in a bubble yet. So how far are we away from a bubble? Because markets first have to hit that bubble zone and then they only blow up after that.
I don't know how to express how far we are from a bubble. I can't express it in miles or in minutes or in percent. I think we're in expensive territory, but I don't think we're in crazy territory. I say in the memo that the PE ratio on the S&P is like 24. In 2000, it was 30. That was unprecedented high territory. So I don't know how to express it. I don't know what the units of bubblishness are. I wouldn't say we're a little high. That understates it. I wouldn't say we're in bubble territory. That overstates it. I would say that we are in meaningfully expensive territory in most assets, meaningfully. But in the economy, we have not had a boom, and I see no reason to have a bust. There are no arguments for or signs of a recession anytime soon. And the financial institutions, which were really the site of the problems back in the global financial crisis, the financial institutions are not nearly as levered as they were then. So I hope that risk is off the table. And then the global financial crisis was caused by something called subprime mortgages and mortgage-backed securities. And there is no analog today to subprime mortgages in terms of the the magnitude or the fundamental weakness and the inherent weakness.
You have highlighted the super stocks and the FANGs. So let's talk about that, because every market has its super stocks, right? In India as well, we have the consumer companies, the large cap private banks, which are trading at supernormal levels when it comes to valuations. Most fund managers who we speak to and ask them about where's the balance between growth and price, and they tell us that, look, you're buying into the certainty of growth that these companies can deliver. My question to you then is, they are being defensive in that strategy. Do you think that a defensive strategy can also turn out to be risky, subject to valuations?
You hit the nail on the head, Tanvir. Subject to valuation. One of the important points that I try to make, and this is a point which is forgotten in every bull market, is that there is no such thing as a good idea in the investment world without reference to price. Anything can be a good idea or a bad idea on its merits, depending on how it's priced. So if you say, I'm going to be cautious, I'm going to invest in the defensive stocks like the major consumer companies, and if everybody says it, and if these stocks double and triple in price, then while the businesses may be defensive, the stocks may no longer be defensive. And people have to understand the difference between a company and a stock. A stock is not a company. And the main attributes of an investment in a stock may be different from those of the company. And, in my book, The Most Important Thing, Chapter 3 says the most important thing is value, by which I mean trying to figure out the intrinsic value of the stock or other investment. And Chapter 4 says the most important thing is the relationship between price and value. And that is really determinative. If you are buying a great thing at a modest price, it's wonderful. If you're buying a great thing at a eye-popping price, it may no longer be wonderful. It's probably a mistake. You can buy a bad asset, a risky a stock in a risky company, but if you buy it cheap enough, it may be very defensive. So all I would say is never forget the difference between the thing you're buying and the price of what you're buying, and you must consider both. And the key to cautious investing is to pay a reasonable price relative to the underlying intrinsic value.
Right. Mr. Marks, what is your take on China? It is a difficult equity market and a credit market to read. The economy is still opaque. Do you think the China fear is real? It is more like a ticking time bomb, or right now financial markets can handle this uncertainty from China?
I'm not an expert on China, and I haven't been there in some good time, and I don't think that you know the answers to these questions just by visiting for a few days, as I typically do. You look at China, which has the challenge of urbanizing its people and growing while limiting the reliance on capital investment and borrowed money, and the growth over the last 10, 15 years has been highly dependent on investment in the capital stock based on borrowed money, and now they try to transition from that to internal growth and more prudent financial investment. Nobody can say, nobody can prove, nobody can research, nobody can detect whether it's going to work or not. First of all, this is something that has never been attempted on this scale before, and there are no schematics for how this machine works. I think that the Chinese have done a very good job of managing things. The people who called for a hard landing 3 years ago are still waiting. You know, the Chinese system seems to have a unique combination of some capitalism, some central control, and some very purposeful and effective management. Personally, I don't bet against China in this regard, but I'm going to conclude my answer with what I started with. I'm no expert on China. All I have is my hunch that they will be able to accomplish it.
Oh, absolutely. Actually, nobody in this market claims to be a China expert because of, the depth of that market and the opaqueness with how the economy operates. But Mr. Marks, I have to ask you on the path ahead for U.S. interest rates, because a large part of, your memo talking about there being bubbles in asset classes or potential bubbles in asset classes is premised on the fact that a lot of fund managers, investors do not want to be caught waiting on the sidelines in anticipation of when rates will go up. Even central banks are not clear about the path ahead for interest rates. How much, by when, is all data dependent. What's your own view here?
People have, on May the 22nd, 2013, Ben Bernanke said, I think you're going to start to see signs of tapering in our bond buying. And everybody started to believe that the road for U.S. interest rates was upward. And ever since then, that's now, it's almost 4.25 years. Ever since then, people have said, when is the Fed going to raise rates? And my answer is always the same. Number one, I don't know. And number two, why do you care? First of all, nobody knows what the Fed's going to do, and the opinions on what the Fed's going to do change all the time. And secondly, what matters is not what day they're going to raise interest rates or how big the increase will be that day. What matters is what will be the general direction of interest rates over the coming years. Will they go up or down? And if up, will they go up a lot or a little? And will they go up slow or fast? And nobody, I don't think, can know any more than that. If that, I think knowing that would be a great thing. So here's what I think. I think interest rates will go up, not down, because I think they are unnaturally low, which distorts the economy and the markets. And I think that the Fed knows that it's not desirable to have unnaturally occurring interest rates on a permanent basis. And I think that the Fed knows that as the economy tightens, as the unemployment rate goes to 4.4 and 4.3, I think that the slack goes out of the economy and the opportunity for inflation rises. And of course, one of the Fed's main jobs is to limit inflation. So I think that there's every reason to believe that interest rates will go up. I also think that our economy is growing only very slowly, and so there is a strong desire not to raise rates so much or so fast to choke off growth. They want to limit inflation without jeopardizing growth, which is a balancing act, which calls, in my opinion, for few, modest, and slow increases in interest rates. But anybody who bets that interest rates aren't going up, I think is taking a big risk.
Very quickly, Mr. Marks, where do you think emerging markets like India would fit in? Because a market like India is following a different interest rate regime.
Well, I don't know anything about interest rates in India. I think that I'm a great believer in the emerging markets. As you know, I made my first trip to India in February, and I was very impressed by the people I met and by the power of the country. And I'm a great believer in India's future.
Well, Mr. Marks, we can't thank you enough for an engaging conversation. Thanks very much for taking out the time to join us all the way from New York for this special edition of The Global View.
And it's always a pleasure to speak with both of you.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.